Today we are going to discuss about factors influencing net returns of a mutual fund investment in India, while gross returns illustrate the fund's investment prowess. Net returns, what an investor actually takes home, are significantly influenced by three key factors: expense ratios, exit loads, and taxation. Understanding these elements is crucial for a complete assessment of investment viability. Expense ratio, direct versus regular plans and current-day investment scenarios. We do have direct plan available, which we can buy directly from fund company without any broker. We need to buy any fund with name direct included from the fund company website. This will have minimum fees compared to regular plan. The expense ratio represents the annual percentage of a fund's assets used to cover its operating expenses, including management fees, administrative costs, and, crucially, distributor commissions in the case of regular plans. This ratio directly impacts an investor's net returns. Direct plans. These plans are purchased directly from the asset management company, without involving any intermediaries like brokers or distributors. This lower cost means a larger portion of the investor's money remains invested and compounds, leading to potentially higher net returns over the long term. The difference in returns can be substantial due to the compounding effect over many years. For instance, a direct fund might have an expense ratio of 0.5%, while a regular fund could be 1% or higher. This seemingly small difference can result in a significant disparity in accumulated wealth over a 10 to 15-year horizon. Direct plans are generally suitable for investors who possess sufficient investment knowledge and are comfortable conducting their own research and monitoring their portfolios. Regular plans. These plans are bought through mutual fund distributors, financial advisors, or brokers. The expense ratio for regular plans includes the commission paid to these intermediaries for their services, such as providing investment advice, handling paperwork, and offering ongoing support. While this convenience and professional guidance can be valuable, especially for new or less experienced investors, it comes at the cost of a higher expense ratio and consequently lower net returns compared to direct plans. The net asset value of regular plans is also typically lower than that of direct plans due to these higher expenses. The choice between a direct and regular plan should align with an investor's knowledge, comfort level with self-management, and perceived value of advisory services. Next, let's discuss about exit load. An exit load is a fee imposed by fund houses when investors redeem their mutual fund units within a predefined, usually short, holding period. This charge acts as a financial disincentive to discourage premature withdrawals and promote a more committed, long-term investment approach. The primary objectives behind imposing an exit load include balancing investor commitment. It encourages investors to stay invested for the long term, aligning their behavior with the fund's objectives. Mitigating market impact. Frequent large-scale redemptions can force fund managers to sell underlying assets, potentially impacting the fund's portfolio stability and the returns of remaining investors. Enhancing fund manager focus. By reducing short-term redemption pressure, exit loads allow fund managers to adhere to their long-term strategies without constant distraction. Exit loads are typically expressed as a percentage of the redemption amount and vary based on the fund type and holding period. For equity mutual funds like Flexi cap funds, a common exit load is 1% if units are redeemed within 12 months of purchase. If the investment is held beyond this specified period, the exit load is usually 0. For SIP investments, the exit load applies individually to each installment. The holding period for each installment begins from its respective investment date. and the load is charged based on whether that specific installment meets the minimum holding period at the time of redemption. The exit load is deducted from the redemption proceeds, directly impacting the net amount received by the investor. For capital gains tax calculation, the gains are computed on the redemption proceeds net of any applicable exit load. Investors can minimize the impact of exit loads by aiming for a longer investment horizon or by choosing funds with lower or no exit loads, particularly if they anticipate needing to liquidate their investments earlier. Next, let's discuss about taxation of capital gains and dividends in India. The taxation of Flexi funds, being equity-oriented mutual funds, falls under the equity taxation framework in India. This involves different tax treatments for short-term capital gains, long-term capital gains, and dividends. Short-term capital gains. Profits from the sale of Flexi fund units held for 12 months or less are classified as STCG. The tax rate on STCG from equity-oriented mutual funds has been increased from 15% to 20% if sold on or after July 23, 2024. If sold before this date, the old rate of 15% applied. This higher rate increases the tax liability for short-term investors. Long-term capital gains. Profits from the sale of Flexi fund units held for more than 12 months are classified as LTCG. LTCG on equity-oriented funds is subject to a tax rate of 12.5% on gains exceeding 1.25 lakh in a financial year if sold on or after July 23, 2024. Previously, the rate was 10% on gains exceeding 1 lakh. This means gains up to 1.25 lakh per financial year are exempt from tax. Dividends payouts. Dividends received from Flexi funds are taxed as per the investor's income tax slab rate. This means dividend income is added to the investor's total income and taxed accordingly. If dividend income exceeds 5,000 in a financial year, a 10% tax deducted at source is applied. For SIP investments, each installment is treated as a separate investment for tax purposes, and the holding period for STCG or LTCG calculation starts from the date of each individual installment. This implies that even if an investor redeems their entire SIP portfolio, gains on installments held for more than a year will be subject to LTCG tax, while those held for less than a year will incur STCG tax. Investors are advised to consider these tax implications when planning their investment horizon and redemption strategies. Holding equity mutual fund investments for at least 1 year is generally recommended to qualify for the more favorable LTCG tax rate, which includes a threshold exemption rather than incurring the higher STCG tax rate. Tax-saving strategies like tax loss harvesting and utilizing the 1 lakh LTCG exemption can help optimize post-tax returns. Thanks for watching. In next session we will discuss about key conclusions. See you in next video.